Very good morning, everyone. I hope you all are doing good. So, as you know, we have started the remaining portions of the FSR report, and tomorrow will be the last lecture of this series. So, yesterday we discussed different stress analysis for the banking system, used the different stress test done by the RBI, macro stress test, and what has been the result of all these tests, right? And we have seen that the Indian banks, particularly the scheduled commercial banks we have seen so far, on all the parameters or tests, they have been able to stood by, right? So this is the result. We have discussed the SCBs, their capital adequacy, GNPA, their performance on all these stress tests and all. Now next thing is sensitivity analysis in the series, right? Sensitivity analysis. So what is sensitivity analysis? If you see the difference between the macro test and then the sensitivity analysis, it says macro test, as I told you, is something which was associated with the performance of the macroeconomic parameters, right? In the sensitivity test, we apply some hypothetical situations and then we try to assess the sensitivity or the soundness or the resilience, right? So this is the difference. So if you see under macro stress test, the shocks are in terms of adverse macroeconomic conditions, while in sensitivity analysis, hypothetical shocks, as I told you, are applied to single factors like GNPA, interest rate, equity prices, each of them, and then the test is done. So in sensitivity analysis, we give them hypothetical shocks. We try to imagine, okay, if this happens, if this shock arises, if this situation arises, if there is interest rate risk, what will be the impact on the net interest margin, for example, right? So this is the thing. Now in the sensitivity analysis, if you see what has been the result, so for the sensitivity analysis, single factor sensitivity analysis are conducted for a sample of 46 SCBs accounting for 98% of the total assets of banking sector. So you remember that whatever the result we are going to discuss is for 46 SCBs, right? 46 scheduled commercial banks. They constitute almost 98% of the assets of the banking system. So first sensitivity which the report talks about is credit risk sensitivity. I have discussed with you what all different types of risks are, right? So there is credit risk or default risk. Just giving you a hint very quickly so that I need not repeat it again and again, right? So credit risk is basically risk associated with the chances of default on your payment, right? This is credit risk, also called as default risk. Then you have interest rate risk. As I have told you, interest rate risk, any changes in the interest rate in the market can affect the net interest income or margin of the banks, right? And then there are certain other risks which are going to come, say market risk, and then interest rate, equity price risk. So whatever changes are there in the equity prices can also affect your profitability, all these things, right? So first in the series is credit risk sensitivity. Credit risk sensitivity, if you see, has been analyzed under two scenarios wherein the system level GNPA ratio is assumed to rise from its prevailing level. Okay, so methodology is highlighted here, which is not important for you, but still you can remember that for assessing the credit risk sensitivity, they have assumed that the system level GNPA ratio, system level. So when we say system level CRAR or when we say system level GNPA ratio, that means we are not talking about a particular entity or a bank, right? We are talking about all the banks in a system or all the financial entities in a system under a single jurisdiction, right? So here the system level gross NPA is assumed to rise from its prevailing level. We have assumed it to rise. So by one standard deviation and two standard deviations in a quarter. This methodology is not at all important. You just need to remember the results, right? We have seen the methodology used in the SCBs as well, but results are of use for the examination. So what are the findings of these sensitivity analysis, particularly credit risk sensitivity we are discussing, right? So under a severe shock of 2 SDs, if there is a severe shock, if you remember yesterday's class, we have seen that there is a baseline scenario. So a general anticipation, what could happen, right? Anticipated risks. But then we have medium scenario and then we have severe scenario, right? So under severe scenario, if there is a severe shock, the aggregate GNPA ratio of these SCBs, still SCBs are going on, scheduled commercial banks only are going on, we have not shifted to the other category, right? So aggregate GNPA ratio of all these 46 select SCBs, it would move up from 2.8% to 7.9%. So the report says that if there is a severe shock, in that case, the gross NPA of the scheduled commercial bank, it can move from 2.8% to 7.9%. That means it is risky, right? The system level CRAR, if you see, system level CRAR, it would deplete by 340 basis points from 16.7% to 33.3% if there is a severe shock. If there is a severe shock, so it could deplete the CRAR by 340 basis points, right? Then third finding is the tier 1 capital ratio would go down. This would also go down. So it means there is a risk, or if you do the sensitivity analysis, if you provide this hypothetical situation or shock to the indicators like GNPA, CRAR, tier 1 capital ratio of the SCBs, then under severe stress scenario, these can actually be stressed, right? But this was not the situation under the macro stress test. So remember this difference. Yesterday we have discussed the macro stress test. It is riskier according to the sensitivity analysis. I hope this is clear, right? So tier 1 capital ratio, you all know what is tier 1 by now, right? Tier 1 is the most important one. And in tier 1, you have the common equity and all, right? So tier 1 capital ratio would go down from 14.6% to 11.2%, which would still remain well above the respective regulatory minimum levels. So GNPA ratio can increase, CRAR would deplete by 340 basis points, tier 1 capital ratio can also go down, but still under sensitivity analysis as well, if you see, even if it goes, it stands well above the minimum regulatory requirement, right? So still we are not so much under stress. There can be a risk under severe shock scenario, but not so much stress. This is the finding you have to remember. I hope this is clear to all of you, right? Next, what will be the impact on the capital impairment? Okay, what about the capital? What will be the performance of the capital or the assets of the banks? So the system level capital impairment could be 22.1% in this case, severe shock scenario, under severe shock scenario. Now, so the reverse stress test, if you see the reverse stress test, now what is the difference between this traditional test and the reverse stress test? I'll tell you. First, you see this kind of test shows that a shock of 5.1 standard deviation would be required. At least this much shock of standard deviation would be required to bring down the system level CRAR below the regulatory minimum of 9%. So you would require a very severe stress scenario to bring down this thing below the regulatory minimum, right? That means your banking system is very sound, right? Now, what is this reverse stress test scenario? So traditional test, what we do is we try to assess the future anticipated losses, right? In reverse stress test, we try to find out the causes. So we go retrospectively. Are you getting my point? Reverse stress test mein, so the difference between conventional stress test or traditional one, which we have discussed so far, and the reverse test is, in conventional or traditional one, you try to assess the implications or impact, like this we have discussed so far. In the reverse test, we try to so we imagine the situation, we have this situation, then we try to go back and find out the causes which could have resulted this. This is the difference. I hope you have understood, right? So this is the thing. And a severe stress or a shock of 5.1 SD would require at least, so remember this data, this is important, okay, to bring the entire system level, we are not talking about the one entity, system level CRAR below 9%, which is regulatory minimum. Okay, that shows your banking system is sound enough. Then if you see bank level stress test, it indicates that under severe shock scenario, 6 banks with a share of 11.2% of SCB's total assets may fail to maintain the regulatory minimum. If we see the bank level stress test, only at the bank level, not at the system level, so not encompassing all the financial entities apart from banks, only at the bank level stress test if you see. So bank level test indicates that under severe shock scenario, and this is sensitivity analysis, not macro test, right? Severe shock scenario, 6 banks, if combined together with a share of 11.2% of SCB's total assets, may fail. Still 6 banks only out of 46, if you see, right? So 6 banks which have 11.2% of SCB's total share may fail, right? In such a scenario, the CRAR would fall below 7% in case 3 banks and 5 banks would record decline of over 8% in CRAR. So in that case, the CRAR can fall below 7%, but that is again something which would result if out of these 6 banks which are expected to witness this fall, in case of these 6 banks, 3 of them and 5 of them would require or they record a decline of over 8%. This is not actually practically possible, right? So this is a very hypothetical situation. It might not arise. So if they record at least decline of more than 8% in the CRAR, then only 7% CRAR you can witness, right? Or below 7%. That again shows your resilience. So in general, if you see private banks and the foreign banks, they would face lower erosion in CRAR than PSBs under both the scenarios. So the conclusion here is what you need to remember or retain for the examination. If we see the fragmentation, then that if we talk about the PSBs, private bank and the foreign bank, so which of them will be under more stress in the severe stress scenario? So private bank and foreign bank, they will face lower erosion of CRAR. That means they are more resilient as compared to public sector banks. As compared to public sector banks, right? Thank you, Yashvardhan Chaudhary. Thank you so much. You all are good students as well, right? So that is your quality. All right. So in general, if you remember, what is the take from here? PVBs and FBs at a lower risk, and then foreign banks, FBs ho gaya, PSBs, public sector banks at a higher risk. Just this is the catch. Okay, this is the catch. Why there are various causes to this. So if you see the trend of the PSBs, as I told you yesterday also, they have been major contributors, right, to the NPA. They have been major contributors. And recently, if you see, after the corona pandemic, their trading activity or their trading book particularly, so the financial assets they have been involved in has shrinked, right? So they are not preferring keeping more of the financial assets or expanding their trading books. These are some of the reasons which might affect their assets, right? Or the assets which are at their disposal. Are you getting my point? So one of the reasons can be this shrinking of trading book for public sector banks. This point is going to come further in the PDF as well. There are, apart from these reasons, this is one of the reasons. I hope this is clear, right? Now, so this was about the sensitivity analysis. Then if you see the credit concentration risk. So credit concentration risk shows, first of all, what is credit concentration risk? credit concentration, risk arising out of single borrower or single group borrower exposure. That means if you are lending to only limited number of people, then risk increases, isn't it? Yes or no, right? It increases. Or say your exposure is only to one entity and you have lended out a huge amount to that group or that person, your credit creating or extending process is concentrated. So when your risk is concentrated, it is more riskier, right? That's why you need to diversify your risk. Even if you are investing somewhere, even if you're not a bank, in investments as well, you need to diversify the risk, right? So this is credit concentration risk. You should not have single entity or group exposure to a very great extent, right? So if we talk about the credit concentration risk, what does the report says? Individual borrower stress. So if your individual exposure is higher, right? Individual lending, individual borrower exposure is higher. Stress test done on these kind of borrowings shows, on banks credit concentration shows, that even if the top 3 individual borrowers at each bank, they fail to repay the amount, okay, no bank's CRAR would drop below the regulatory minimum. So this stress test shows, as you see, even if top 3 individual borrowers, all your individual exposures, you see, whatever you have lended out, right? So in that case, top 3 borrowers, individual, we are not talking about the group borrowers, right? Individual borrowers, even if they fail, in that case as well, for each bank, okay, no bank will fall short of the regulatory minimum. This is again very good part. Now, if you see, this report becomes very important because the performance of Indian banking system is really praiseworthy. From the concern which we have been facing for years of rising NPA, now we are saying that even this happens, then also you are above the minimum regulatory requirement for CRAR. GNP constantly declining is actually something, a good achievement, a big achievement for the system, right? So they can ask you questions on these things. That's why. So first thing is this. Next, in this scenario, if four banks would see their CRARs drop by more than 2%, and the system level CRAR would fall by 90 basis points. But if it happens, right, if it happens under the severe stress scenario, for example, होता भी अगर नुकसान तो कितना होगा? 4 banks would see their CRAR drop by more than 2 percentage points, and then the system level CRAR would fall by 90 basis points. Even if it happens or more than this happens, so this much will be the loss, still it is not a bigger threat. I hope this is clear. Right? So this is about individual stress scenario. Then we talk about the group borrower stress scenario. So if top 3 group borrowers in the standard category fail to repay, whatever groups they have borrowed, top 3 group borrowers, if they fail to repay the amount, all banks would maintain a CRAR above 9%. In that case as well, all banks will be maintaining a CRAR above 9%. That is again praiseworthy, right? With no bank's CRAR dropping by more than 5 percentage points. Why? So in this case, you see CRAR drops only by say 2 percentage points, still above the minimum regulatory requirement, or CRAR would fall say by 90 basis points, system level CRAR still remains above the minimum regulatory requirement. Now, next thing which you have is group borrower. In this case as well, even if top 3 group borrowers, they default, still all banks would be above minimum regulatory requirement, and with no bank CRAR drops more than 5 percentage points. And if you talk about the system level CRAR, it would decrease by 130 basis points in this case, but still if you see the overall performance, it remains high. See, confidence, if you see, is not a big issue, because this is financial system and there are ups and downs, and sometimes the performance of the banks and the financial entities, they get affected with the cyclical performance of the economy, right? If your economy is growing, your banks are expanding. If say it is in recession, so it is a process which they know is a part of the process. So not about the confidence of the bank, it's just that you maintain your regulatory minimum requirements, you comply with the regulators guidelines, and you do your work properly, basically, right? So you will be on this trend, right? Now, stressed borrower scenario. Now, if you see, for the top 3 individual stressed borrowers fail to repay, all banks would stay resilient with CRAR dropping by 25 basis point. If there is a stressed borrower means who is already in the line of a stressed borrower. That means there have been cases of default in that case. Stressed assets have been there. Cases of delinquency have been there, right? In that case as well, if top 3 of such individuals, they fail to repay, still the CRAR, they drop only by 25 basis points or 0.25 percentage, right? So 25 basis points or even less, not more than that. Yeah. And the system level CRAR would decrease by 30 basis points under this scenario. Just remember these things. Remember the CRAR for the bank, or in these scenarios specifically, top 3 individual, top 3 group borrowers and all, and then what will be the impact of on system level CRAR. Just remember these things. Then if you see the sectoral credit risk, so by and large sectoral credit risk remains muted. So a 2 SD shock to say basic metals and energy subsectors would reduce the system level CRAR by merely 15 basis points and 13 basis points respectively, whereas the impact of such a shock on the rest of the subsectors would be negligible. So if you see the sectoral risk, if there is any sector which is posing a risk, or any sector to which these banks are lending poses a risk to the bank's balance sheet, not such to a such extent, up to a such extent, right? Even the report says, if say these sectors, basic metals and energy subsectors, basic metals and energy subsectors, so 2 of them are provided here. If they say perform bad, or a 2 SD shock is applied to them to assess the test, even then, because these are heavy industries, why they have taken the example of basic metals and energy subsectors? These are the sectors which have taken a huge amount of loan, right? So these are those sectors, one of those sectors to which the scheduled commercial banks have given a huge amount of loan. So even if they perform say somewhat to a lower extent, in that case also it would reduce the system level CRAR merely by 15 basis points and 13 basis points respectively. So 15 for basic metals and 13 for energy subsectors. Or this shock will not go impact the other sectors or other subsectors. So this is not going to impact the other subsectors, right? Other subsectors, no impact. Only basic metals and energy subsectors will be there, and that too is a mere impact of 15 basis points and 13 basis points respectively. I hope this much is clear. So this was about the sensitivity analysis as well. Sensitivity analysis. Now interest rate risk is there. So interest rate risk is what? Let's try and assess the interest rate risk. If you see, report says that the market value of investments subject to fair value of the sample of SCBs under assessment was 22.4 lakh crore, out of which 89.3 was allocated to available for sale kind of instruments, and then remainings were for held for trading. Now you need to remember that the market value of the investments of these scheduled commercial bank was 22 lakh crore. Remember this figure. I have star marked it because this is important. So this shows the market value of investments done by the SCBs. 22.4 lakh crores. Next thing is, out of this 22.4 lakh crores, if you see the classification, a significant portion, which is 89.3%, was under AFS category. AFS means available for sale, right? Available for sale. And the remaining 10.7% was under held for trading. Held for trading. So this is the difference, or this is the priority which the SCBs are giving for their investment purposes. Now you need to understand the difference between AFS and the HFT. So in the investment instruments, if you see the instruments in which the banks invest, there are these two categories, right? Available for sale and held for trading. Available for sale options means option. I'm not talking about the futures and options. So available for sale instruments, they are generally the intention is to keep them for a longer period of time, or say indefinite period of time, but they can be sold before maturity, right? So they are not for the purpose of trading primarily, these kind of instruments. Are you getting my point? But then this set of instruments held for trading, they are particularly held for trading. So they are kept, or they are so they are kept for a very short period of time in comparison to available for sale instruments. Have you understood the difference? Yes or no? Yes? Then I'll proceed further with the analysis. Okay. So now you have understood the difference. So if you have understood, tell me one thing. So this is my question to you. Why you see more allocation is there to AFS category, AFS, which is 89.3, or if more of there in the AFS, what does it suggest? Tell me, what does it suggest? What does it tell you regarding bank's preference of investment instruments? Anyone? What does it tells you regarding bank's preference of investment instruments, this allocation? Yes, HFT percentage is very low. That's why I'm asking, what does it tell you? Liquidity. Liquidity what? So if you see, that shows that banks are preferring to have more stable instruments. Yes or no? Yes, to a certain extent your answer is close. Liquidity. So they are preferring liquidity over earnings. Yes or no? Right? Now this change, in this change, if you see overall in the system level I'm talking about, PSBs have contributed a lot. That's why I said PSBs, particularly after the corona pandemic, due to those risks which have been faced differently in different sectors, yes, they now having a contraction in their trading book. So these examples, they tell you that why, if you see the entire SCB's composition of investment instruments, this is the composition. I hope you have understood this entire thing now, right? So 22.4 lakh is the entire market value, out of which 89.3 is in the available for sale of, category, and then HFT mein it is only 10.7%. Just remember this, okay? And we have discussed the rationale behind it. This is more than sufficient. Now, this classification reflects banks' strategies in managing their investment, with AFS typically including securities that banks intend to sell before maturities, as I told you, allowing for flexibility in response to market condition. So basically, having more in AFS category gives you a kind of hedge, a kind of protection against risk. So this might be one of the reasons that you are resilient, right? So you don't want to take risk now. So more than profit, more than income, more than earnings, you are preferring stability and lesser riskier options. This is the thing. This is the catch from it. Okay. Then if we do the further analysis regarding interest rate risk, so we are discussing the interest rate risks, right? First point is, if you see the PSB's share in the trading book portfolio, it has been tapering, it has been reducing, while the corresponding share of foreign banks has been rising. Remember this fact. This is something we have discussed so far 2-3 times, that the public sector banks, their trading book, what is trading book? Trading book means, trading book basically records your financial assets, right, which are actively traded. So it has shrunk for the PSBs, but correspondingly foreign banks, their trading book is expanding. So remember, foreign banks are actively being involved in the trading of these financial assets, right? Please explain AFS and HFT. See, as I told you, AFS and HFT, so two kind of categories of investment instruments, right? In available for sale, you tend to hold it for a longer period of time, but you can say sell it out before maturity, right? This is not kept for active trading, but for these instruments which are held for trading, they are actively traded. So what is actively traded, of course, has risk. This is the difference. Now I hope you have understood, right? And the earlier one provides you more stability, or say hedge against risk. So this is another important point. Next, it is assessed that the impact of parallel upward shift of 20 or say 250 basis points in the yield curve on the trading portfolio would reduce the system level CRAR and CET1 ratio by 92 and 93 basis points respectively. This is a bit technical, but what do we get from is, that's why I have added this thing, that it highlights sensitivity of SCB's trading book portfolio to interest rate sensitivity. Interest rate sensitivity. Since we are talking about the interest rate risk, are trading books of SCBs prone to any such kind of risk? Yes, they are. How do we know that? This is something which tells us. So the assessment done by these experts, it says that if there is an upward shift of say 250 basis points in the yield curve of these assets held in the trading portfolio, it would reduce. Why? Because you know there is an inverse relationship. Yes or no? If I ask you about the bond market particularly, so you all know the inverse relationship between price and the yield, isn't it? Right? So this is the thing. Now so we are considering say interest rate rises, or say the yield curve, if there is an upward parallel shift of 250 basis points, right, it would reduce the system level CRAR and the CET1 ratio held by the banks by 92, CRAR 92 and CET1 ratio 93 basis points respectively. So it basically highlights that sensitivity is there. There can be risk. These portfolios are sensitive to interest rate risk or changes in the market interest rates. This is the catch from here. Nothing more than that is important, right? But if you see at the disaggregated level, one foreign bank CRAR will fall below the regulatory minimum in the event of such a major shock. If such major shock happens, say upward shift in the yield curve of 250 basis points, that can affect the CRAR, that can bring the CRAR below minimum regulatory for a foreign bank. Why this is more sensitive? Quick answers, please. Why more sensitive? Because they have a more exposure to this portfolio. If you remember the above analysis, we have discussed that PSP's trading portfolio, it has shrunk so far, right? Contracted so far. Yes, because their trading account is more active and they are having more assets in the trading book. Simple. So that's why their risk or sensitivity is also higher. Very good. So this is the thing. Now, there is another important concept here, traditional gap analysis. Traditional gap analysis. Again, the assessment of the interest rate risk of banks. So this is another instrument used to assess the impact of interest rate risk on the banks. Okay. This analysis gives you some findings. So before going to the findings, you understand what is traditional gap analysis. Traditional gap analysis tries to assess the impact of any change in the interest rates in the market on the net interest income of the banks. On the net interest income of the banks. What will be the formula here? So if you see, under traditional gap analysis, the formula will be risky assets minus risky liabilities. Okay, risky assets minus risky liabilities. Now you tell me, if this comes out to be positive, if this comes out, that means all your risky assets minus your risky liabilities which are there. Risky means which are prone to any fluctuations in the interest rate changes. Right? So if this value comes out to be positive, in that case it shows that the risky assets are more. Risky assets are more means the impact of the change in the interest rate would affect assets more than the liabilities. That means you might gain from the interest rate change. Yes or no? Are you getting my point? And if it is negative, that shows your liabilities are more affected. So you might lose more with the interest rate change. This is what traditional gap analysis, gap of your assets and liabilities tells you. Right? Okay. So this is the thing. Remember this formula and the concept. Okay. So this is it. Now the assessment says that this traditional gap analysis for rate sensitive global assets, liabilities and off balance sheet items, it shows that for time buckets up to 1 year, time frame is 1 year, earnings at risk are assessed at 11.2% and 9.4% of the net interest income for PSBs and PVBs respectively for a 200 basis point increase in the interest rate, whereas the impact would be marginal for FBs and SFBs. So basically it shows, if say market interest rate increases by 200 basis points, in such a shock scenario, 200 basis points it increases. So in such a shock scenario, what will be the impact according to this traditional gap analysis on the earnings and the net interest income of these banks? So it will be 11.2% and 9.5% of net interest income for PSBs and PVBs respectively. That means their net interest income, this much will be affected. Is this clear? So the assessment shows 11.2% of the NII of PSBs might get affected and 9.4% of PVBs might get affected, but this is not so significant for the foreign banks and the small finance banks. This is what traditional gap analysis tells you. I hope this is clear. Right? Then we have the equity price risk. Equity price risk. So equity price risk, what is equity price risk? Any changes in the equity prices. So as banks have limited capital market exposures owing to regulatory prescriptions, any impact of possible significant fall in equity prices on bank CRAR would be low for select 46 major banks. So the report says, since due to yes, Gurleen. Yes, okay. So now we are shifting to equity price risk. Since report is saying that banks have limited capital market exposure, right? So those will be at higher risk, those entities will be at higher risk, which are more exposed to capital market instruments, isn't it? Since due to regulatory prescriptions, they are not at so much exposure of these kind of instruments, their loss arising out of any such shock would be lesser, basically, right? Or fall in the CRAR would not be so significant. So equity price risk is not a threat for the system. This is what the report says, that the numbers, if you see, under the scenario of 25%, 35% and 55% drop in the equity prices. Now this is a good percentage, isn't it? Even if the equity prices they drop by 25%, 35%, 55%, these are the scenarios, the system level CRAR would reduce by 23 basis points, 32 basis points and 51 basis points respectively. This is not a huge fall, right? So still we are very much resilient in terms of equity price risk as well. I hope you are clear with this segment now. Then if we talk about the liquidity risk, liquidity risk basically tells you the risk which you have in, say, managing your day-to-day operations or upcoming operational liabilities, right? So liquidity risk in an extreme scenario of, say, sudden and unexpected withdrawal. Now how can liquidity risk arise? There can be a bank run. What is a bank run? Or a run on the deposits. That means, say, more of the depositors all of a sudden they come to withdraw their money, right? That can reduce your liquidity very drastically, right? So in an extreme scenario, first scenario is given here of sudden and unexpected withdrawal. If such sudden withdrawal of deposits happens from your bank of around 15% of uninsured deposits happens, along with utilization of 75% of unutilized portion of committed credit lines, liquid assets at the system level would decrease from 21% of total assets to 10.4%. Now what does this mean? It means if, say, 15% of the uninsured deposits, all of a sudden people come to withdraw these, but at the same time 75% of the unutilized portion of credit lines means like loan only, so you have multiple access to this amount, credit lines, even at the same time with the combination of 75% of such portion being utilized simultaneously, in that case the system level CRAR would decrease from 21% of total assets to 10%. Now liquidity risk is higher, isn't it? It is not much significant, but still we cannot ignore this thing. So sudden withdrawals can pose a risk. Are you getting this thing? Yes or no? Remember this figure, okay? 15% withdrawal, 75% utilization of the credit line, this will happen. Okay. Then under the assumption of 75% utilization of these unutilized funds, okay, reverse stress test, again reverse stress test applied here, it reveals that for majority of the banks, an uninsured deposit runoff of over even 30% is required to knock off their liquid resources completely. If reverse test scenario we see, so this test shows how much sudden withdrawals will be required to knock off or to wipe out these liquid assets of the banks completely, at least over 30%. Over 30%. Over 30%. Now this will be a big shock. This is not something which can happen usually, right? So in extreme conditions like some financial crisis or what. So for example, in 2008-9 financial crisis, bank runs happened in US as well. So these kind of situations, they are not normal. They happen with any global or national financial crisis like situation. So you require at least 30% of runoff of your deposits, or of such runoff 30% to wipe off your liquid assets or liquidity completely. This is the thing. This is what the report tells you about liquidity risk assessment of these SCBs. So we have discussed so far all the risk associated with the SCBs. I hope you all are clear with all these type of risks and their performance regarding scheduled commercial banks, right? Now the next category is primary urban cooperative banks. So here again concepts are same. We just need to go through the trend like we have seen the SCBs. What is the trend? What is the risk assessment or findings for primary urban cooperative banks, right? So now the category has changed. Now we have urban cooperative banks, UCBs, okay? So first thing, if you see the credit growth scenario for them, so credit by these banks, it has recorded a dip. Remember, credit growth for urban cooperative banks has recorded a dip on year basis, okay? In second half of the 23-24 financial year, it stood at 5.7 as of March 2024. So you can remember this figure, 5.7. See, I always tell you ki the extremes, if there is increase and if there is fall is important. So fall is there in UCBs, so 5.7%, right? Now, both scheduled UCBs and non-scheduled, they have recorded moderation. So this credit growth scenario, credit growth has not witnessed increase in terms of UCBs. It has fallen down. This is the general take, right? Now, next, capital position if we see for these urban cooperative banks. So the capital position of UCBs has been continuously improving. This is a good sign, right? Their capital position is improving in the post-pandemic period with their CRAR increasing to 17.5%. So their CRAR is well above the minimum regulatory requirement, right? Well above the minimum regulatory requirement, and their capital position is also improving. What is the CRAR requirement for UCBs? Can you tell me? What is the minimum requirement of CRAR for the UCBs? So this is a good position. This improvement has been experienced across both scheduled one and the non-scheduled one. So remember, both kind of UCBs, scheduled UCBs and non-scheduled, the capital position is improving and their CRAR is also expanding. And presently, it has increased to 17.5% as of March 2024. Remember this thing, 17.5%. Okay. So you are saying 9% for all UCBs, is it? Is it there for all the UCBs? Or is it different across tiers of the UCBs? Shreya. Okay, I'll tell you this thing in the end of this class. First, let's discuss the GNPA ratio then. So, GNPA, if we talk about of this thing, the GNPA ratio and NNPA ratio has decreased, okay, except for a marginal uptick in the non-scheduled one. Yes, very good. Very good. So, this is UCB, minimum regulatory requirement, CRAR. For tier 1, it is 9% only. Rest of the tiers, 2, 3, 4, it is 12%, right? But this is 17.5%, way above the minimum requirements, isn't it? For all the tiers, if you see. Yes, very good. So, GNPA ratio and NPA ratio has declined, but if you see, for some of the non-scheduled UCBs, it has been a marginal, not significant, just a marginal uptick, but overall it has declined. So, that is again a good sign. Next, if you see the provisioning coverage ratio of UCBs, so trend in provisioning coverage ratio also shows improvement post pandemic. It has increased. Okay. Now, this is important. What is provisioning coverage ratio? It tells you how much of your NPA have you kept as provisions to cover the losses. If say whatever NPAs you have, so the formula will be total provisions divided by your gross NPA. So, provisioning coverage ratio formula will be total provisions divided by gross NPA. Okay. So, it tells you how much you have kept aside to deal with any of the losses arising out of your gross NPA situation. Clear? That has improved. Yes, provision made against the NPA. That has improved. That means you are secured. You have less liquidity risk, right? You will be in a position to manage the losses because you have more provisions made against those NPAs. Simple. Then GNPA ratio of large borrowers, which accounted for 24% of the UCB's loan book, followed similar trend. So GNPA ratio of the large borrowers, if you see, which accounted almost for 24% of the loan book, is also declining. So overall trend you see regarding GNPA for UCBs is on a declining trend. That is a good sign. Then if we see the profitability, so profitability has went up. Right? So you see capital position is good, GNPA or NNPA declining, right? Profitability is going up across the scheduled and non-scheduled categories. Then if you see, why are we saying that? Because the profitability indicators like return on equity, return on assets, they have increased. So they are performing well. That's why. Okay. And the net interest margin of UCBs, it remained healthy at 3.7. Remember this figure. I have star marked this thing. So what is net interest margin of the UCBs? They have been performing good. So this can be asked. Net interest margin has remained in the second half of this 23-24 fiscal year. It is 3.7%, right? Net interest margin. 3.7%. So these were some of the performances of the UCBs. Now if you see stress testing again done, what stress testing has been done on the UCBs and what they have found out. So stress testing. Stress tests were conducted on selected set of UCBs to assess their credit risk, default risk, concentration risk, market risk, right, and liquidity risk. So for this purpose, 170 UCBs with asset size of more than 500 crores, excluding banks, under the Reserve Bank's all-inclusive directions were taken for the test purpose. 170 UCBs. Now this also becomes a question. Tell me quickly, how many SCBs, select SCBs, these tests were performed, stress test, whatever test it was there. How many SCBs were there? Quickly, how many SCBs were there? 46. Very good. So remember, in UCBs it is 170, and those SCBs, they reflected, or they accounted for 98% of the total banking system, right? Their assets. So 98%. Here, if you see, 170 UCBs have been taken for the stress test. How many? 170, right? 170 with asset size. Remember this thing. So on which kind of UCBs they have performed this test, then we will move to the findings. 170 with asset size more than 500 crores. This is the thing. Remember this line. 170 UCBs with asset size of more than 500 crores. Right? But they have excluding banks under the RBI's all-inclusive direction. Remember this thing as well. This is very, very important. What have been excluded from the list or the test? They have excluded the banks which have been kept under all-inclusive directions. What are all-inclusive directions of the RBI? So all-inclusive directions, these are the guidelines or the regulatory requirements or directions issued by RBI. Remember, under section 35A, yes, under section 35A or of Banking Regulation Act, section 35A of Banking Regulation Act. This is done, all inclusive directions, these are provided to select banks for primarily for two purposes. First, for ensuring the safety of the depositor, that the depositor's money does not get at risk. And then second thing, ensuring financial stability in the bank as well. They particularly include these urban cooperative banks, right? So these are not included because since they are kept under this AIDs of the RBI, so their performance might be different from the general norm. Are you getting my point? Now, what has been the result? So one bank in the tier 4 UCB sample, say largest category, which is, okay, so before moving ahead, for all those who don't know these tiers, just a quick go through of what all these tiers are. So as per RBI has classified these urban cooperative banks into 4 broad tiers. Okay, so tier 1, tier 2, tier 3 and tier 4. So it depends on their deposit size, right? For this, deposits are up to 100 crores. Deposits are up to 100 crore. And for tier 1, the CRAR is 9%. Okay, CRAR. For second tier, this is from 100 to 1000 crore, right? Then for tier 3, this is from 1000 to 10,000 crore. And for tier 4, this is more than 10,000 crore. And for remaining 2, 3, 4, the CRAR is 12%. You can take a screenshot of this thing, so you should remember. It will be helpful for you to revise, right? This is CR crore. Is it clear? Okay. Now, so moving back to the analysis, now we see the result. So now you know what is tier 1, tier 2 UCB, right? One bank in the tier 4 UCB. So tier 4 is the largest one. One bank, the largest category, would fail to meet the minimum regulatory requirement of say 10% CRAR under a severe stress scenario for both credit default risk and credit concentration risk. Now this is not 10%, this is 12%. 10% is those who have not been able to comply with, तो उनको एक guideline दिए कि इतने time तक फिर कम से कम इतना कर लेना. So that is what 10% is referring to here. Is this clear? No confusion should be there. Okay. So if under a severe stress scenario we see severe stress scenario, in the largest category, one bank would fail to meet the minimum regulatory requirement for both credit default risk and credit concentration risk. This is not a much riskier thing, right? Only one bank. Then, so this is the largest one. Usme to sirf one is there at risk. Then if you see the tier 2 and tier 3 UCBs, impact of any credit risk is default, chances of default. Credit risk under severe stress, this is significant. Why? So see, as you move down to tier 1, the chances of credit risk will be higher. Chances or impact of the credit risk will be higher. Why? Because they have lesser deposits, right? So if anyone defaults, that might affect their liquidity conditions. So this is very commonsensical. So tier 2, tier 3 are at more risk as compared to tier 4 in terms of credit risk. Next, for the smallest UCBs, if you see tier 1, liquidity mismatch, it may exceed 20% under all scenarios. So under all scenario, baseline scenario, medium stress or severe stress, most vulnerable will be tier 1 category. It might exceed 20%. Is this clear? So you can remember it like this, that the broadest category or having the largest amount of deposits, it is at lesser risk because it has good deposits. That's why you see liquidity is associated with how much deposit you have. Your resilience is associated or linked with this thing. If you have good amount of deposits, your liquidity condition would be, you will be stable financially, right? Then under severe stress scenario of credit default risk, credit concentration risk and interest rate risk in the trading book. Now if we talk about the trading book risk of these UCBs, the system level CRAR would reduce from the pre-shock position of say 16.5% to 12.5%, 13% and 15% respectively. So it is saying if we talk about any such shock, severe stress, what will be the impact on the trading book? In that case, the system level CRAR for credit default will be this much. So impact from 16.5%, it will reduce to 12.5% in case of a credit default risk. In case of credit concentration risk, it will fall from 16.5 to 13%. And in case of interest rate risk, the fall of CRAR will be from 16.5 to 15.4 respectively. Right? So if you see 16.5 say 12.5, 13% and 15.4 is there respectively for the system level CRAR. So if you see the interest rate risk in the trading book, this will be a lesser decline, isn't it? 16.5% say only 15.4%. Why? Because again, they are not much exposed to the financial assets. This is the reason. Okay. If they ask you the highest category, which is at risk due to interest rate associated risk or stress, will be which category of banks? So far, which we have discussed. So far. Foreign banks. Very good, right? It will be foreign banks. Now, a severe interest rate shock in the banking book would dent the NII by 6.1% at the system level. So this is about trading book. But if there is a shock in the banking book, interest shock, that would reduce the net interest income of these urban cooperative banks at the system level by 6.1%. Now this is something of a concern. That means banking book is at more risk in case of UCBs than the trading book. Can we conclude this regarding UCBs, right? So if they ask you any question, you should be in a position to eliminate the options. The conclusion is, for UCBs, credit growth has declined, but all other things have improved. That is capital position, provisioning ratio, and profitability indicators and all. If you see the stress indicators and their findings, so it shows trading book is at a lesser risk, but the banking book is at a higher risk. Is this clear? Right? So we have discussed the UCBs as well and their entire scenario. Now we will resume from the NBFCs. What does the report says regarding NBFCs? Their credit growth, capital position, profitability indicators, stress test done on the NBFCs, and then the findings. After NBFCs, we will start with a new sector, which is your insurance sector. And now not much is left, right? So I'll only take one more class to complete the remaining report. Only one more class will be required. So the next class will be your last class for FSR. Okay. If you have any doubts from today's class, you can ask me. I hope you are getting all these things and it helps you in your examination. The concepts might help you in the phase 2 and the data will help you in the phase 1. If we try to give them the weightage according to the level of the exam. I know it is very technical, but then try to remember the important things. Okay. Yes, you should brainstorm, right? You should brainstorm. All right. No doubts then? So then we'll meet in the next class, most probably tomorrow only, and then that would be the last class for FSR, so that you revise all these classes, right? We'll try to cover whatever is remaining in this last class. MCQs. Okay, so if time allows, I'll also take MCQs on the FSR. Okay, if time allows, I'll take MCQ classes on the FSR as well. If since we will be able to complete this thing tomorrow in the last class, I think I'll be able to take the MCQs as well. I'll consider this thing. Okay. All right then. Thank you so much. Have a good day. I'll see you in the next class. Be there in the next session. Thank you so much.